Good afternoon, everyone. Thank you for joining us here on our latest edition of Financial Fridays here with Thimble Island Private Wealth. Again, my name is Matt Fleming, a certified financial planner here with Thimble Island Private Wealth. And today we're very fortunate to have joining us on our call Jeff Bookbinder from LPL Financial Strategic Research Team. And Jeff's joining us today, really to spend a little bit of time with us talking a little bit about sort of a mid-year review. We like to, at certain points through the year, sort of take a look and, okay, where have we been? Where are we going? What are some of the trends and some of the things to be thinking about for the next half of the year when we're looking at portfolios? And Jeff's a contributing member of some of the commentary that we really lean on LPL Research for as well when constructing portfolios and looking at client accounts and doing reviews. So we thought it'd be really beneficial to have Jeff join us here today and spend a little bit of a time sharing with us on some of the insights on some things to be thinking about for the second half of the year, and certainly answer any kind of timely questions that you might have at the end there. So, and as always, these programs are really meant to be sort of informational for you. And if there are specific questions that you have about your individual scenarios, portfolios, et cetera, we're happy to sit down and review with you. If you're an existing client, we're probably already doing that on a pretty frequent cadence with you. But if you are not a client of ours, we'd be happy to be sitting down with you, talking a little bit more in detail about planning, portfolio, and how we can help align both together to meet some of those goals that you have for the future there. So with that, again, as I mentioned, we're very fortunate to have Jeff joining us. He's a vice president, chief equity strategist with LPL's research team. And with that, he's a key contributor to the research, as I mentioned, that we really lean a lot on when we look at portfolio constructions, et cetera. And he regularly is communicating these sort of market strategies, client letters, et cetera, for LPL as well. And prior to joining LPL back in July of 2003, excuse me, he worked as an equity research associate for Sanford C. Bernstein in New York and Deutsche Bank in Boston. So Jeff's bringing more than 25 years of experience to our conversation here today and has earned his MBA from Duke University and a BA from Northwestern University in economics. So again, Jeff, we can't thank you enough for spending a little bit of time with us here today. And we're all really interested to hear a little bit more on kind of where we think we might be headed here for the next half of the year. So with that, I'll turn it over to you here and look forward to the comments.
Wonderful. Thanks so much, Matt, for the kind introduction and for having me on. Always enjoy these conversations. I'm also glad that it's this time of day, because it is 80 degrees with a clear blue sky outside today in Boston. I'm sure it's pretty similar where you are. Just a gorgeous day. So hopefully you can all get outside here soon. So thanks for joining. So I'm going to go through our Midyear Outlook publication that we just put out. Certainly Matt can help you get a copy of that if you haven't seen it. We typically just do like an intro and then get right into the economy and the stock market and the bond market in these publications, which we've been doing for almost as long as I've been at LPL. We started doing these during the financial crisis in, I think it was 07 or 08. But we did something different this time. I don't think we've ever done it this way before, where we led with 4 themes. So the first of the 4 themes is the midterm elections. These are 4 themes that we think are going to shape market action in the second. So on the midterms, just high level, the market and we think we're going to get divided government. The party in power loses on average more than 30 House seats in the midterms. So if the Republicans lose anywhere close to that, the House is going to flip. Betting markets have about an 85% chance of the House flipping. So we're under the assumption, and the market is too, that we're going to get divided government. So what does that mean? Well, typically the market is more calm when you have divided government because it takes extreme policies out of the equation. For example, big tax hikes or big tax cuts. Those are not happening. Certainly, some of the major healthcare policies in the past have created market volatility. We're really not going to get much in the way of changes in healthcare policy. We're certainly not going to get a $1 trillion stimulus package either, right? Again, we've had enough of those. We can't afford any more of those. So that sort of, I mean, some of these are good policies, some of them are bad, some of them help the stock market, some of them hurt the stock market. The point I'm just trying to make is historically, midterms are really volatile. We don't think this year is going to be as volatile as midterms have been historically. So instead of maybe a mid-teens correction, which is very common, we think we're going to get maybe something more close to 10. Obviously hard to predict, and there are other risks to the market, but that's how we're thinking about it. So you're going to have this continuation of regulatory changes and rulemaking. You're going to have executive orders. We know how Trump operates, right? So it's not like they're not going to be able to do anything, but it just takes the extremes out of play. And historically, gridlock has been good for the market. So that's something we'll have to watch. But for now, we don't think the midterms are particularly worrisome. In fact, they may actually help us bring this Iran conflict to an end here in the next month, we hope. All right, theme number 2. This one's a little bit different. We call this theme resource nationalism. This chart just shows you export bans. So this is countries, this is in the case of this chart, it's the US, not sending key commodities or other key materials overseas, right? It sort of rhymes with deglobalization, rhymes with more isolationist or nationalist type of trade behavior. You've all heard, I'm sure, about the rare earth metals problem that we have. A lot of rare earths that we rely on China for are, key materials into defense equipment and tech equipment and all of that sort of thing. So as the world gets a little more protectionist, we think that can or will put a little upward pressure on inflation because it costs more to bring this stuff in house. Now, this is no more obvious than it is with oil, right? We are greatly benefiting from having our own energy supply, right? For obvious reasons. So the US is in much better shape than Europe and Asia in terms of energy, given what's going on in the Strait of Hormuz, and on the other side of the Arabian Peninsula now with the Houthis trying to stop the flow of tankers through that strait. So it's rough over there, but the US is very well positioned. I certainly don't have to tell any of you that, I am sure. So we just think that inflation is going to be a little stickier than maybe the market thinks right now, although that's a different question for whether the Fed is going to hike. So I'll get into that in just a minute. So actually there's just a headline now that Pakistan is going to try to bring the Iranians and the US to the table to negotiate another ceasefire. Even if oil goes back down into the 60s after a ceasefire, inflation is not going to immediately come straight down. It's just going to be kind of a gradual process. So look for inflation to come down maybe in Q4, but not so much in the current quarter. All right, next theme, AI. You could have guessed this before I even flipped the page, that AI is going to be a theme. Certainly getting a lot of attention in the markets, and a big reason why we were up 10% in the S&P 500 in the first half, roughly. So this is a chart of capital investment. These 5 companies are spending something like $750 billion this year, which is a lot. Don't have to tell you that. It's a big, big number. And it's still growing very rapidly. In fact, Alphabet just reported earnings the other night, and they said that this is expected to increase dramatically in 2027. So this chart directionally is probably right. We'll see what we hear from these other companies. The point is, there's a lot of capital spending going on. Now, this is important from a market perspective in the second half because all of the cash flow from these companies is basically gone. They are taking all of their cash flow and putting it into building data centers, putting chips in, putting servers in, all that stuff. You've effectively had the biggest transfer of cash flow of all time from the hyperscalers to the infrastructure makers. Okay. So mainly semiconductors and memory chip makers. Those are what gets most of the attention. But it's also servers and other hardware equipment that certainly has been booming. So what does this mean for the markets? What we're saying is that scrutiny on this capex is going to ratchet higher in the second half and create volatility in these stocks. You're seeing it today. You're seeing it pretty much every day. Some days the semis are up 3 points. Some days they're down 3 points. Some days the hyperscalers are down because of the worries about too much investment and it might be wasteful. Some days they're rallying because the market sees that, well, there's valuations are attractive and they're growing really fast. That debate's just going to continue to play out, and we're not going to know how wasteful this spending is going to be, or if it's going to be wasteful, until probably 2027, 2028. So it's driving a big earnings boom. That's helping stocks, but it's also, we think it'll lead to a little bit of volatility in the second half, which we've started to see over the last month or so. All right, theme number 4 is the Fed transition. So Kevin Warsh is coming in, taking over for Chair Powell. I think the biggest change going from Powell to Warsh, and we wrote about this in the Outlook, is that he's not as big of a talker. He doesn't value transparency. Now that sounds bad, but I would argue it's not all bad, because if the Fed talks too much and you have too many people at the Fed talking, the market gets confused. And then the bond traders just try to game the Fed every day. It's just not a productive activity. Warsh does not want to pre-commit to rate hikes or rate cuts. He's also repeatedly said he's not just going to do what Trump asked him to do. So we still think Fed independence is intact, despite the transition from Powell to Warsh. So could you get a little more bond volatility because the market could get surprised? Yes. But I also think the market is going to be comfortable just sort of waiting between meetings and is probably going to follow the data more closely, which is really what matters, and then trade their bonds accordingly. So right now, the data's been good, right? Economic growth expectations have been ratcheting higher. That has been pushing treasury yields higher. We're at 465, I think, today on the 10-year. That is doing a little bit of the work for the Fed. So we don't think they're going to hike next week. We also think it's probably a coin flip that they hike in September, but it's a little early to make that call. So there's sort of two sides to that debate. All right, moving on from the Fed, economic outlook is pretty good. We have the AI investment that is driving economic growth. We have stimulus that it's not getting as much attention because the tax cuts, you know, the one big beautiful bill and the no taxes on tips and the no taxes on overtime and all of that stuff that already kicked in, but it's still an economic driver. Business tax incentives are still affecting CapEx decisions for property, plant, and equipment. So you put all that together, despite the headwinds of more inflation, which is certainly hurting the consumer a little bit, especially at the low end, we still think we're going to grow 2.5% or so. Maybe a little less than that in the second half, but somewhere in that range. The consumer spending bars here are the blue and the red. That's amazing that the consumers hanging in there so well, despite 3.5% inflation still. And we've had a little bit of deterioration in the job market, not much. AI is not taking all our jobs. That is not evident in the data. It probably won't be for a while. And even when it is evident in the data, it's probably going to be gradual. Because remember that historically during tech revolutions, and there's no doubt AI is a revolution, historically, the workforce reinvents itself. And you end up on the other side with at least as many jobs, if not more. So we think that probably plays out this time, although we certainly recognize the risk. We certainly know that some basic consumer service jobs and call centers are going to go away. They already have. But this is a services economy, and it's going to be very tough to replace jobs in mass. I actually listened to Mark Cuban on a podcast the other day, and he's trying to do this at his portfolio companies. He's a VC investor. And he said it's going to take a long time, and I agree with him. It's going to take a long time to integrate AI into this economy at scale, right? Into corporate America at scale. Companies are just trying to figure out how they're going to do it. So the job market's probably going to hang in there. I got a slide on that here. I'll show you in a minute. All right, here's inflation. So you see this blue line, that's the Fed's preferred inflation metric. It's the PCE, excluding food and energy. So the personal consumption expenditures index, or PCE, on a core basis, ex food and energy. And of course, as we all know, we're painfully aware, the inflation rate spiked during COVID. It's been slow to come down. And now that we have higher oil prices, I think WTI just dipped under 90, but it's too high. Now that we have high oil prices, that is going to lead to a little bit of a short-term bump up in inflation. So that's this kind of bump up here into the mid threes. But as you can see here in this shaded area where we have the forecast, we think it's going to come back down. The economy is not growing fast enough to overheat. AI is helping productivity. When you have more productivity, you can grow without bidding for labor. You can grow without driving wage pressures higher. So that's good for inflation. And we think the Middle East will calm down again. And that obviously is hard to predict. But we're under the assumption that oil is going to be back down in the 70s by the end of the year, hopefully in the 60s. We'll see. All of that, we think, will result in lower inflation. So we think we can get to the twos by the end of the year and maybe 2.5 next year. That's a pretty good rate for the Fed. But you're going to see wars continue to talk tough on inflation. And we have to continue to watch oil prices. So near term, sticky. Medium term, better. All right, here's the job chart. The blue bars, or the blue section of these bars, is the important piece of this chart. That is private service sector jobs. That is where most of the jobs are, where most of the jobs are being created every month. We've been adding about 110,000 jobs a month the last few months. That's a pretty healthy rate. You only need to add about 55,000 a month to keep the job market stable. So in other words, to prevent the unemployment rate from rising. We think we can do that, mostly. We're forecasting maybe about a 1/4 point increase in unemployment, maybe 30 basis points. Not much, so a little bit of AI job disruption, but more than enough to keep this job market growing and to hire the people that are entering the labor force, young people, netted against the people that leave. I actually got this question yesterday. We've seen more people leave the labor force since COVID than we have seen historically. But there's been a lot of wealth created, and a lot of people my age and older have been able to retire early, or just work part-time. I know several people in that category, even though they haven't turned 60 yet. So the job market is in a very healthy place, and wage pressures are modest enough that we're not worried about the Fed doing any sort of series of rate hikes. They also don't want to hike rates just because oil's up temporarily. So that's a pretty good picture. The economy's doing just fine. Low twos growth rate, just fine. A lot of this investment is going to result in higher productivity. That's good for inflation. So we're pretty positive. The risk, again, is that some of this AI investment is wasteful, and the market gets worried about cash flow. All right, let's go to the stock market here. The biggest support for stocks has been earnings, which of course is coming from the AI investment. In fact, all of this earnings surprise this year is pretty much AI. So start of the year, we thought we'd get around $300 in earnings. Actually, the LPL forecast was $290, which was way too low. That is in large part my fault. But I'd rather be wrong by being too conservative than being wrong by being too aggressive. So we thought, 290, consensus was around 300. but now we're tracking to 340. That almost never happens where the market misses or the analysts miss earnings by that much. In fact, the only times it's ever happened in the last 40 years or so when earnings estimates became a thing is when you come out of recession. So coming out of the 2020 pandemic, analysts were too pessimistic, earnings surprised on the upside. Coming out of the great financial crisis in 2009, analysts were way too pessimistic. Boom, hockey stick of earnings, companies cut costs, market roared back, and we got more earnings than we thought we'd get. That repeats itself, right? Coming out of recessions, you tend to get surprised on the upside. Well, this isn't a recession. I mean, you could argue that we had a recession in 2022, but it officially was not a recession. But even if you say it was, we're well past that. So this spike is all just surprise AI investment. Coming into the year, the consensus was for about 525 billion in AI capex from those hyperscalers, we call them, those big five tech companies building all these data centers. Now the consensus is about 750, and that's probably going to 800. That money is going into earnings somewhere, right? The transfer I mentioned. It's basically hyperscaler cash on balance sheet all went to AI capex, AI infrastructure. So massive earnings avalanche. It's hard to envision the stock market selling off dramatically when this much spending is going on and this much earnings. But if we do have volatility in the second half, and I've alluded to it a couple of times already, it's going to be because cash flow is depressed. So I created this chart showing you valuations on earnings against valuations on cash flow. Over the long term, cash flow valuations actually matter more than earnings valuations, although they track very closely over the long term. They have disconnected this year because the earnings hits right away. And that is bullish, right? It's keeping PEs down. The E is the earnings, right? So it's keeping valuations down. But by draining cash flow, that payoff comes much later when these big tech companies are able to monetize all these investments. When companies start, buying more AI capabilities and they incorporate it into their business processes and their workflows and all of that, and they drive productivity and they drive margin expansion and all of that stuff. The dream of AI, right? Well, that's going to take more time. So we are in a period of depressed cash flow where something has to happen. One of two things. Either this investment has to pay off and these big tech companies drive future cash flow growth, or they're just going to have to cut back on their spending if this AI capex does not pay off. And then they're going to have to drive improving cash flow just by reducing capex, capital expenditures, capital investment, all synonymous. So we think we're going to get more of the payoff than the fail, right? That's basically a fail. We shouldn't have spent all this. We're going to ratchet it back. It's not quite doing what we thought it would do. Is it going to be sort of 70% useful, 30% wasteful? Going to be 80-20. Honestly, that's anybody's guess at this point. It's early, but based on what we're seeing, we think most of it will be useful. And we're going to end up with good margins for corporate America and better cash flows, several years out. But we're going to have to be patient for that payoff. So this chart shows tech positioning. This is a really simple concept, but it's complicated to build the data set. So we use our partners at Vanda, a company called Vanda Research. They're able to take basically hedge funds and related types of institutions and look at how much tech they own, and then compare that to how much tech they've owned historically. So let's see, this chart begins in 2010 when they started creating this data set. So back in 2011, 2012, coming out of that downturn, companies, institutions, there's some retail here too, but they're big retailers, big retail investors, and they're trading in the futures market. and the options markets. So it's not me and you buying stocks. It's these big retail shops buying stocks. But it's a pretty robust data set. So back coming out of the Great Recession, we had a lot of tech, right? Companies were institutions and these big investors were buying a lot of tech. So we got to 3 standard deviations above the norm at that point. We didn't get back there until just the past couple of years. 3 standard deviations above the mean is a lot. That is stretched. Well, in just the last couple of months, we hit 6. And so you don't have to be, a data wonk to recognize that this is an outlier. So we were overweight tech, coming into June. We downgraded it to neutral. And this is the biggest reason why. Because the market just got overloaded with too much tech. Some of these chip makers were up 90% in less than 3 months. That is not normal. Historically, that does not get sustained. So we made a call, our team, LPL Research, that we need a little bit of a, let's call it a blow off, right? Let's call it a consolidation, right? Digestion, whatever term you want to use. We have seen this play out. So neutral tech, we think, is the right place to be. Now, that means you own a lot of tech, because if you're neutral tech, as you know, Matt, that's like a third of the index, right? So if you're neutral, you got plenty of tech. If you're using the LPL portfolios, you got plenty of tech. But we just want to highlight that it's a little stretched. Still, it's come down. It's now more like 3.5 standard deviations above the mean, but still stretched. All right, so here are our forecasts for the end of the year, and we hope we're wrong. We hope we're too conservative, but we think 77.50 is a reasonable upside target to shoot for. We're around 74.50 now, so a few hundred points of upside, but with some ups and downs around the AI debate, right? Is this investment going to pay off or not? We are a little bit conservative on our earnings forecast for 2027 at 350. Most strategists that we follow think we're going to be in the 360 range, maybe 370. We'll see, but this is 20% earnings growth this year and 10% next year. That's a pretty favorable outlook. So we'll see. But again, AI investment is going to be the big driver here. More than half of this earnings growth is coming from AI. All right, got just 2 more slides on bonds, and then we'll stop and happy to take questions. So for the bond market, our chief fixed income strategist says it's going to be a keep calm and carry on second half. So that just means coupon clipping. We are slightly underweight bonds in our target allocations, but we still think you should have a good amount of bonds. The reason that we are underweight bonds primarily is because the market expectations have flipped. Coming into this year, the market thought we would get 2 Fed cuts. Now the bond market thinks we're going to get a hike. Maybe even 2, but that's a little less likely. Now, the market does a terrible job of predicting Fed rate changes historically. I mean, there have been epic misses. I mean, we're talking about, it was a couple of years ago, the market thought we'd get 7 cuts in a year, and we basically got 2. I mean, so we don't put a lot of weight on that. I don't even, we might not have even gotten 2 at that point. We have gotten a couple of cuts this cycle. So don't put too much weight on this, but just know that the bias for the Fed is toward a hike. And that connects to the 2-year yield, because the 2-year yield trades on where the Fed is going to go. And then the 2-year yield trades on, or is connected to the 10-year by the yield curve. I know that's kind of inside baseball. I'm an equity guy, so I'm not even that interested in all this stuff, to be perfectly honest. But I have seen the data, and it's convincing that what you're likely to see is the Fed kind of hold serve, kind of be in that 375, 4% range. And then the yield curve push the 10-year yield, or keep the 10-year yield around 4.5. Okay, that's our base case forecast. That the 10-year yield ends the year at 4.5 or lower, And if inflation cooperates and oil cooperates, maybe we could be at 4. So that's where our range is. We were at 375 to 4.25 to start the year. We've raised that range. We think 4 to 4.5, which means that we think rates can go down a little bit from here. Actually, I'll look and see where we are at this minute because it's so fluid. Yeah, 466 on the 10-year right now. So maybe a little bit of downside, but not much. And there's a little bit of risk, of course, that rates go up. We don't have a crystal ball, but we still think maybe 475 and then move lower between, let's call it August through year end. So that's a reasonable forecast, we think, for bond market. That means you're going to clip coupons. You're not going to get a lot of capital appreciation. If we thought rates were going back down to 3.5 or 375, we'd be loading up on bonds. We would probably be overweight bonds, but that's not the way we see it. We want to be conservative with our bonds. Last slide. This is just the hyperscaler debt. So these 5 big tech companies that are starting to go to the debt markets more and more. This just increases the risk in corporate bonds slightly. But even our bond strategists would agree that this is not a huge risk. These companies are very high quality credits. They can pull back on this investment if they need to. Their core businesses, this isn't like 1999 when companies were going public that didn't even have a business, right? These companies were very well established. These companies had the best balance sheets that we've ever seen coming into this AI investment cycle. Nonetheless, it's still a little bit worrisome that Alphabet is now cash flow negative. Some of these companies are probably going to move to cash flow negative on a short-term basis because of the massive investment. And they can't just fund it with the cash flow that they've already generated. They're having to go to the bond market. So just a little bit of a watch out. Again, it doesn't change our view that the stock market's going to do pretty well in the second half. It's just a risk factor. So, Matt, I'll go and stop there. I think that was pretty close to where I thought I'd be on time. Let me just go through these disclaimers really quickly, and then I'll happy to entertain questions. So hopefully that was interesting for you and helps you think about where markets might go in the second half. I hate to say cautiously optimistic, but that's kind of where we are. We feel pretty good, but we certainly recognize that the geopolitical picture introduces risk, and we certainly recognize inflation's sticky. That introduces some risk. The bond market introduces some risk, and we haven't been here before, right? This AI build out, we've never done anything like this before, so we just think it makes sense to be a little bit cautious and be a little bit below consensus, and wait and see how things play out. So, with that, Matt, back to you. And
thank you, Jeff, for I took a bunch of notes there. I went through the mid-year outlook, but always nice to kind of hear it in somebody else's words, sort of summarizing some things too. So I took some few notes there. And we've sort of echoed your comments there about cautiously optimistic to a lot of our clients as well for kind of the second half of the year for many of the reasons that you talked about. And the thing that I was going to kind of circle back to as well is that earnings number. I didn't realize LPL was below the 300 number for earnings expectation for this year initially. But that continues to be sort of what surprises every time, especially the major companies, it seems like too, or they're just kind of coming out and crushing the earnings numbers and expectations on every call. So that continues to be why we're as well a little bit optimistic, because we're seeing such robust earning numbers from a lot of the companies that are driving the overall stock market. But inside the portfolios that we help manage and help clients with as well is it's being cognizant of some of the risks that we talked about. And that's one of the key levels of diversification that we try and add in. And one thing that we didn't talk too much about, and I'll ask the first question, and folks, if there are questions, certainly jump in and if you use the react button, it'll raise your hand and we can unmute you. But just curious, Jeff, I don't know if you can elaborate a little bit on kind of the international versus domestic landscape in terms of the equity markets. I know historically over the last 10 years, our personal portfolios here at Thimble Island Private Wealth with many of our clients, we've been underweight international, which served us pretty well up until really last year. And we've been dabbling in sort of getting gradually back into that international landscape, but still remaining a little bit underweight, by comparison to sort of some of the benchmarks, if you will. But I was curious, just again, kind of your guys' outlook in terms of what that sort of international, emerging market space as well as developed international markets, potentially could be on the horizon for the second half of the year.
Yeah, good question, Matt. It's I think if there's maybe one takeaway in terms of how to invest for us in the second half, and this was the case generally speaking in the first half too, but I think it plays out more in the second half, is be diversified, right? Because when money moves out of these big tech names or just the tech sector in general, which it's doing today, as an example, where do those dollars go? They're not leaving the equity market. The equity market globally, the equity market's been well supported during these sell-offs in tech, right? It's really been more of a rotation. And so international has been one of the recipients. Now, we're neutral, just high level on developed international and emerging markets equities, but that gives you more than 20% based on how we measure international exposure, right? Based on how we benchmark the global allocations. So that's a pretty meaningful chunk. So we think that's about right. Target maybe around 20%. Now, what's interesting this time, and this is new, EM is so AI heavy now. Korea and Taiwan weights in the EM index are bigger than China now, which I never thought I'd see. Used to be it was all China, 40, 50% China, and nothing else mattered. So back to the tech discussion we had, when we looked at positioning in Korea and Taiwan, that was stretched too. Those markets did better than the US semis did because they're so sort of concentrated in the AI trade, right? So we think it makes sense to be a little bit careful in EM, given how AI sensitive it is. But we are neutral and we're just kind of adjusting positioning by country to be a little bit more careful with some of those high flyers. What's tricky in EM, or in developed international, is Europe is so dependent on energy through the strait, right? And so is natural gas and oil, and so is Asia, but particularly Europe. And Europe's not benefiting from the AI trade. They don't really have much of a tech sector. So near term, we think the outlook in Europe is a little bit worse than it is for the US and for EM. Maybe Japan looks a little bit better than Europe. Their economy is a little bit more dynamic and a little bit more better positioned for the tech cycle, the innovation cycle that we're seeing. And their exporters are benefiting from a cheap yen. So I'd say within the neutral, like Japan a little better than Europe, and then want to be a little careful with these high flyers in Southeast Asia because, oh my gosh, I mean, I don't even know what the returns have been on those tech stocks in Korea and Taiwan, but they've been moonshots before the recent sell-off. I mean, they've come down 25, 30%, and you barely even notice on the chart because they went parabolic before that.
Absolutely.
So that's how I think about international. Last thing, the dollar is a key driver of international returns, and we've expected the dollar to roll over when the Fed cuts. We've just had to wait, obviously. We've had to wait longer for that Fed cut than we thought we would, given what's going on in the Middle East. So watch the dollar closely. It's been strong, which means favor US right now. But when the dollar starts to roll over, that's when international, including Europe and Japan, can really do well. It's just been a drag here lately.
Thank you. I appreciate that. Well, with that, Jeff, again, I can't thank you enough for taking some time here on beautiful Northeast Friday to speak to our folks and clients here, and impart a little bit of knowledge on us. So thank you again for the time here today, and folks for joining us on the call. Again, we certainly appreciate you taking time out of your day as well, and hopefully find some good information on these monthly calls. Be on the lookout. We do have our next call taking place in the month of August, and the date on that one's going to be on, Friday, August the 14th. We're going to be doing a little bit of a basics on investing. So keep an eye out for that invite to come through. And as always, if there's anything that we can be doing for you, don't hesitate to give us a shout here at the office, and we'd love an opportunity to kind of sit down with you and put together that financial plan. So with that, we'll hope everybody has a wonderful weekend. And for those here in the Northeast, hopefully you can get outside and enjoy some of that beautiful weather. So, Jeff, thanks again, and have a great weekend.
Thanks, Matt. You too. Thanks, everyone.